Welcome everybody to today's InvestHorizon webinar on getting investment ready. I'm Jan Bandler and I work for the InvestHorizon team as a lead account coach, and I'm your moderator of this webinar session. I'm very delighted to see so many people with us to discover an entrepreneur's way to become investor ready. For this session, we have Uwe Helgott from Jura Ventures with us, who will be your speaker today. I will be introducing him in a moment. Before that, just a quick reminder about the rules for this session. I would like to remember that this is a recorded session that will be available for replay on the InvestHorizon platform. Please keep yourself muted during the entire webinar. Use the question function to ask questions during the Q&A session at the end. And please do let me know if anything is not working for you. Before we start with Uwe and our webinar content, I want to share with you the next InvestHorizon Accelerator cutoff. The next cutoff will be on May 20 at midnight, and we are looking forward to welcome new innovative companies in our program. The Accelerator program lasts around 7 to 8 months, and after the application phase, where the InvestHorizon partners select the companies based on their IRL level, you will receive trust group coaching. That means you will be together with other companies in trust groups. You learn to improve your investor readiness level. You will receive coaching. You will be in exchange with other companies facing similar problems. And you will already have the opportunity to ask for contact exchanges from an investor side, business partners, R&D partners, and so on. At the end of the trust group stage, we are organizing a 3-day bootcamp, which is a physical event to round off what you have learned in the trust groups and sharpen your profile. In the best case, you have already reached an IRL at this point, which makes you fit for investors. At the end, you might then have the chance to further improve and meet real investors in physical events, e-pitches, pitching fora, and academies. Here you can see the timeline and events for the next 2 InvestHorizon cutoffs. We would be more than happy to welcome lots of new interesting companies in our InvestHorizon Accelerator. With that said, I now want to introduce our speaker for today. With me is Uwe Helgott from Jura Ventures. Uwe is a very experienced investment consultant at Jura. He holds a master's degree in business administration, major new businesses, and his expertise is in the development of sustainable business models, matchmaking deals between startups, investors, and pilot customers, and in the field of transaction and transformation management at the venture department of Jura. Last but not least, Uwe is also a lecturer for economics, finance, and investment, and marketing at the University of Aalen. With that said, I want to hand over to you, Uwe, to show our attendees how they can improve their way to get investment ready. And the attendants, please feel free to already ask questions to the presentation provided to you. Enjoy.
Thanks a lot, Jan, for your introduction. Also from my side, morning everybody. A warm welcome to our webinar today. In the next 20 to 30 minutes, we want to talk about making your business investment attractive. But first of all, a question. Did all of you know that only 50% of startups survive more than 5 years? Applying for investment is a positive, but also an exciting step forward for your business. The process, however, can be tiring and also can be long-winded. Investors will hear about many potential investments during their time, so why should they give you the time of the day? You need to make them see that you and your business ideas are investable in. Having an investor that's experienced in your business size and industry and suits your culture and way of working can lead to an investment worth far more than the on-the-paper total. In turn, applying for investment is much like auditioning for a play. Your performance has also to resonate with that of your audience. Typically, the development and also the investment curve of a successful business looks like something like this. Clearly, the investment readiness looks different at each stage. So at the absolute startup stage, at the proof of concept stage, the amount is typically 50,000 to 200K, and the so-called investors mostly are family, friends, and fools. The amount rises up during the seed phases, up to 100 to 500K typically, and the most investors in these phases are business angels, but also early VCs. During the serious phases, the amount could rise up to 500K to 2 to 4 million in some cases. This represents the main VC market and in parts also for institutional investors. And after that, during the expansion phase, beyond the series phase, the amount rises up to several to tens of millions and typically represents the PE, IPO market or also secondary purchases. During the seed phase, investors do not expect you to have a complete team or detailed answers for all upcoming questions. But investors expect you to have thought all about the topics of above and made also sensible and realistic assumptions. Engaged with customers, even if you haven't sold anything yet. But during the serious phases, investors expect you to have a complete team fit for the stage you are at, and you have most of the answers or at least provable assumptions and begun to sell products to live customers and this to be growing. You have to convince investors that the following stack up. First of all, the idea, the technology, and very important, the value proposition of your company. Your market, your target market, your customers, your audience, the competition, your scale-up potential, and the most important topic, your team. Summarize all these topics in a structured and clearly business plan and derive from that your funding journey. But in general, keep in mind, investors always think simple. So please keep it structured, simple, and stupid. All of these topics are critical, but above all else, it is the team which wins it. Make sure to tell your business story as well as your financial story. Most investors come from business backgrounds themselves and are likely to resonate with aspects of your entrepreneurship journey. So, for example, what are your development requirements? Are there any technical developments? What is required to convince people it works? Are there some regulatory hurdles? The first step, building a smart growth strategy, is understanding your startup's value proposition. The value proposition should explain how your startup is uniquely qualified to meet or exceed all the customers' expectations. So what is your USP? Highlight this. It is what makes you stand out to your audience, so give it the center stage position it deserves. Highlighting the ways you've overcome challenges and hardships in the past. Highlight also your IP if it is available. But it is because this is a huge amount, a huge value in which potential investors can invest in. A truly great value proposition introduces you to a prospective buyers and helps you also make a strong first impression. Your value proposition should describe how your product or service solves, improves the problem of your customers, what benefits customers can expect, and also why customers should buy from you over your competitors. Proof that you understand the world outside of your business. Even the strongest business plan doesn't mean much if you walk into a saturated market with no idea who your audience is. Is it a new market? Is it an existing market? Is the time right now to enter this market? What is the total available market? And what is the serviceable available market for you? Sneak also market knowledge into your talks alongside your forecasts. For example, Brexit or currently the Corona crisis. Reassure them with a clear action plan about how to tackle and take advantage of these. Following the above points, your investor is also going to want to have confidence in your ability to risk assess. Map the risks in your plans and don't be afraid to talk about them. So you can also enforce that your business is a safe place for their investments. And therefore make the ride easier for investors by having already considered their worries. In some times it also could make sense to use scenario planning tools to model potential actions and see their best, worst, and middle customers and outcomes. Ask yourself, how does your route to market looks like? One of the biggest mistakes companies make is not talking to their customers enough. I think all of us know that. Get your product into their hands as quickly as you can because continuous customer feedback is a key. Ask yourself questions like, who is the end customer? For example, is it a doctor or is it a patient? Who makes buying decisions or who influences buying decisions at the buyer's side? How does the buying cycle looks like? Where are the budgets? So it is essential to identify your target audience. Without a clear understanding of your audience, you are more likely to iterate on the wrong product enhancements, build, for example, the wrong marketing messages, and more. These miscalculations can cost your startup thousands of euros. Fortunately, there are a number of ways to identify your target market. First of all, the most probable one, review personal networks. Ask your family, your friends, your colleagues, for example, also your funders and mentors, to examine your product and your service. Use their feedback to craft some assumptions about your target users. But you can also gather survey data or analyze market data to create a buyer persona. I don't know if everyone knows what a buyer persona is. A buyer persona in general is a fictional representation of your ideal customer with their unique qualities and so on. Monitor your competition. Your competitors may have already solved the challenges that you are currently facing. In essence, by monitoring your competition, you might find also a shortcut towards success. In my opinion, one of the most reasons why people do not analyze the competition is the fear of discovering that their product or their service is not as good as their competitor's product or service. Fail to monitor the competition and you might become another WeSap. May some of you know WeSap. WeSap was a personal finance startup, a personal finance platform which did not monitor the competition and failed, which did not monitor the competition enough and failed. Even though WeSap was first to market, Mint, the competitor, who has a strong value proposition and offered a more seamless user experience and innovated its way to the top. It is necessary to really understand and also to really outline your USPs and make sure they matter to your customers. Analyze the competition objectively and in detail. Remember that competition is global, even if your initial market also is local. Spending too much money before establishing product market fit is the #1 reason for premature failure. One of the easiest way to maintain a low burn rate is renting, for example, co-working space, especially for you as startup founders. Startups who choose co-working space over traditional office space typically save tens of thousands of euros per year. They can also quickly scale up or scale down without having to pay astronomical fees or break expensive lease agreements. So scale on the one side vertically, but also horizontally. But in both cases, scale responsibly. Scaling your business vertically, for example, by selling more of the same products. Scale up your business horizontally, for example, by adding more products to your catalog. If you have a product-based business, wholesaling is also a great option to scale it up. But in general, keep in mind, finding scaling opportunities is easier said than done, of course. However, trial and error, you can reach your goals. It is necessary to establish KPIs. One of the most popular growth metrics includes the customer acquisition costs, which is the price you pay to acquire for a new customer, or also the customer lifetime value, which represents the total net profit attributed to a customer during his or her relationship with your company. The burn rate, which we talked already about, the rate at which a company spends money. The gross profit margin measures revenues after paying the cost of goods sold, and also the conversion rate, which measures the desired actions that customers take. But always remember, identify the KPIs that have the biggest impact on your definition of success, of course. Now I want to come to the most important topic of today's webinar, your team. Get everybody involved. Make smart hires and invest in talents. Finding the right people to work for your startup is not easy, but it is extremely important for you and also for your company, for your success. According to the US Department of Labor, the price of a bad hire is at least 30% of the employee's first year's earning. For an early stage startup, a 5-figure investment in the wrong employee can cause a significant loss of traction, momentum, and profit. So you should make use of your team, because they are the people you've already entrusted with the future of your business, of your company, and hopefully they are motivated and interesting people. Getting your team involved gives also a business some character in your investor's mind. Introducing your investor to a team of people that dedicate their time and effort to believing in and building your business might just tip the scales in your favor. But also it gives a great insight into your company culture and ultimately what your investor is investing in. From an investor point of view, it is much harder to say no to a lovely group of people you've met and interacted with than just to one person. So ask yourself your question, are you a team? Did you make smart hires and invest in talents enough? Summarize all the topics we've talked about in a structured and clear business plan. But please don't fill your business plan with unnecessary jargon. Keep it simple, keep it easy to read and straight to the point. This not only will help the investors follow your plans, but it will display also your efficiency, your professional approach, and also your determination. The main reason most startups get rejected for investment is because they don't have a well thought out startup growth strategy in place right now. Investors are not interested in how dynamic the idea is or how much potential it has to change the world. Rather, they are interested in finding how its growth potential, strategy, business plan can provide them with, of course, recurring returns later on. From that, derive your funding journey. Have a clear idea of what you want and make this clear in your discussions. How much will you need to get the product on the market and selling? Look also for what you are looking now, but also the end-to-end amount. Even if you can't predict sales, you should understand your costs in detail. My suggestion is pick funding the amount you want and double it. This does two things. First of all, it forces you as founder to think about your business at a larger scale. And the second topic, it allows for the truth that, first of all, the revenue typically takes twice the time to come in and at half the amount the owners originally anticipates. And on the other hand, costs come in twice as fast and twice the size of what owners anticipate. Determine the valuation of your business. And also decide what proportion of your business you will give away for that investment. For an early stage business, for a startup, use discounted cash flow method, discounted cash flow approach to determine the return on investment, less an allowance for risk. I know, of course, it's difficult to know for early stage companies how successful they will be. So in some cases, these are projections, these are assumptions, these are rugs. Use also scenarios could help to build worst case, best case, and middle cases. On the other hand, for an established business, a common rule of thumb for your industry based on a multiple of turnover or profit. For example, 2 times annual turnover or 3 times profit. Ask yourself the question and make it clear, what will you do with the funds? The purpose of the investment is, of course, critical. Investors need to understand how the investment will make a step change in your business. This may be through increasing management capability, improving or developing technology, increasing marketing, or a combination of the above, of course. But in all cases, please be realistic. Here you can see the typical process steps from matchmaking, from the first contact with potential interested investors in the company to the deal closing. For that, first of all, create an informative pitch deck which includes the information we've talked about right now. Create a long list, which is a compilation with potential contacts with the highest matching potential, and out of that, made a short list with candidates with the highest matching potential. Try to get in contact with the candidates. For example, by intermediates, by M&A boutiques, or also by yourself. If there are some investors who are really interested in you or in your company, in your business case, ask for a request for a proposal, ask for a process letter, ask for a bidding procedure. Process your data, your company data, clearly and structured in a virtual data room. Coordinate and schedule a due diligence, or in some cases, before the due diligence, a so-called pre or light due diligence. Ask your potential investors for a letter of intent and also for a request for qualification. Organize and schedule plant tours and also management meetings between your team, and the team of the investor. Be prepared for detailed Q&A coming out from the tax, legal, environmental, and also commercial due diligence. Create with your investors detailed terms and conditions to create the term sheet. Contract the draft, made a contract drafting, you can sign in. Establish the effectiveness of the contract so you can close the deal. You can see this is a really long and huge process you're in, and therefore the question is, are you ready to build your growth plan to get investment ready? I know every startup needs a solid growth plan, and every plan must include a unique value proposition, a clearly defined target market, an outline of the right KPIs, smart hiring system at least, competitors analysis, and also careful financial planning. By this summary, I come to the end of my presentation today. Thanks a lot for your interest. Thanks a lot for listening. Thanks a lot for participating. And now I'm happy to hear your questions. Thanks a lot.
So thank you very much, Uwe, for this very interesting insights on what is important to become investor ready. I will now invite you to send your questions to our speaker via the question function in the system, and we will try to answer all of your questions immediately. But before we go over to the Q&A session, I want to hand over to Robert Sanders from Innovate to share some interesting content with you.
Hi, good morning, everybody. Thanks, Jan, and thanks, Uwe, for the very informative presentation there. So, Robert Sanders from EBN here. Just a quick teaser about another project called Innovate. This is a Horizon 2020 project running for 3 years and will end in December 2021. The main objective of Innovate is to help drive the move towards the development of an EU financial system. And we're inviting innovative tech-driven SMEs to join us to pilot a process which is starting in May to hopefully get easier access to financing solutions, obviously, which will then help companies to scale and to grow. Now, this actually is based on a proven and tested system that came from South Korea. It's actually called the Kotek Technology Rating System, and it's already supported hundreds of thousands of innovative SMEs in that region. And they've actually, using this tool, have accessed over, I think, 75 billion euros. So we're adapting to the European context, if you will, a tried and tested formula. So how does it work? Well, on the platform, there are going to be a series of tailored services for companies and also investors. So investment readiness to help companies get ready for those important pitches and connections. Matchmaking, and we're going to obviously put together companies and investors. And the most important thing probably is a whole set of data analytics. There is in stage 1 a pre-screening service, so a company can log on and therefore they can see via a digital analytics service a rating of their innovation. And after that, they will be matched to, on a one-to-one, to an expert who will bring in obviously a human touch with a lot of expertise using their market and technology expertise to give what we're calling a deep assessment of the company. And then obviously that will be available for investors, and hopefully therefore the connections will be made. So you can see on the slide there quite a few details about the touch points, the connections via the website and also Twitter and Facebook. And we will be starting the pilot in May. So please go to the website, have a look, and if you're interested, come and join us. And we also hope to be connecting with InvestHorizon more and more in the near future. Thanks very much.
Thank you very much, Robert. In between, I received a couple of questions already from your side. One thing I want to mention first, as this question popped up very often already, if we can share the presentation with you after the session. I'm not sure about, I need to check with the organizers so far. However, you will definitely be able to watch the whole webinar again as a replay on the InvestHorizon website. So in case you have any questions on any of those slides, just go to the website of InvestHorizon to webinars, and then you can revisit and go to the slide you want to see. In between, Uwe, if you're ready, I want to share the first question with you. I grouped it a little bit into categories. First category is related to the investor itself. And one question of a participant was, what are the best suitable kind of investors for my business? Business angels, venture capitalists, private equities, and so on. And what are the advantages of them?
Mm-hmm. Well, there are a lot of kind of different investors. For example, the angel investor is usually a wealthy entrepreneur who wants to leverage their wealth by investing in projects they are passionate about. So the advantage is especially for startups that may have difficulty accessing more traditional forms of finance. On the other side, there is the so-called venture capitalist, or in some cases also the institutional investors. Venture capitalists, we've already seen it on a screen today, typically invest millions in a company or in general higher amounts in a company. by securing a share in the company known as equity capital. The investment is predicated on the idea that the equity capital will increase in value over the time, of course, and they receive a return on their initial investment. But therefore, in all cases, is it necessary to have a solid and on a growth strategy based business plan. For example, there are also institutional investors or traditional banks, but it is more and more challenging, especially for growth companies, for very young growth companies to qualify for a bank loan. In last time, there is more and more done also silent participations. This is a method where investor, or also so-called a silent partner, participates in the commercial business of another person, of you as a startup in your company, by providing a defined amount of capital deposit, and also in return, of course, receiving a participation in the profits of the company. This has the advantage that the silent participation will generally not be discernible for outsiders, because there is no requirement of enrolling the silent participation in something like a register of corporations or something like that. A most popular investment type in last time is the so-called convertible loan. The convertible loan is a short-term debt that covers into equity. Usually it converts in at one of the next investment rounds. And the advantage of the convertible loan from the perspective of an entrepreneur is, of course, that the convertible loan before its conversion behaves very much like a standard loan, like a standard loan of an institutional investor, for example. Investor typically does not have many of the rights of a professional shareholder in the company. For example, board seats, liquidation preferences, and so on. He becomes, by the time when he get an equity loan. And also, since the convertible loan itself is a fairly short and simple document, it also gets executed faster. That's why the convertible loan investment can be processed faster than any equity investments, which needs a couple of weeks or a couple of months at least. And a convertible loan, for example, can be made in a couple of weeks. So I hope this was the longer answer for the question.
Okay, thank you, Uwe. Another question arrived, which is a little bit more on cash flows. So the question was that, or the statement was that one of the pains of deep tech startups is how to create cash flow projections while the technology is not ready to the market. How can such a startup present those cash flow projections to investors, even with the high degree on uncertainty?
Yeah, well, you can do this by VAX or by assumptions, especially in the biotech or healthcare market. This is a topic, and you can also generate cash flow by selling, for example, probes or also studies, and also you can licensing, for example, your technology in a very first status to generate a constant cash flow, not at the huge amount you need it, but also it is a provable method to generate constant cash flow.
Okay, thank you, Uwe. Another question was more or less on the team slide you presented, on the team importance. So the question was, if there is not yet a team in place, but interested team members are here that would be willing to participate when a specific investment is available, would this be already enough for a Series A funding, for a Series A investor? So the team is not set up yet, but there are already potential team members said they will join if the investment is available. And
Well,
second part of the question was, sorry, if a 20 million euro need is still a Series A funding.
it could be, yes. It depends of the stage of your company. But coming back to the first question, you have to show it in the business plan, and you have to show it also in your funding journey, and you also have to discuss it directly by potential investors, why you need the amount, why you need the investment, and why the investment is essential to build up the team and also the requirements to get the KPIs defined in your business plan. So if you can talk to your customer, to your investor, and make it clear, make also a clear process and process steps, why the team and also the specific team members are necessary to rise up and also to scale up your company, why not?
Okay, thank you, Uwe. Another question is more or less a follow-up question on the convertible loan you presented. One participant is asking about convertible loans or obligations. I understand that it is very complicated to agree on the terms and conditions and implement it. What do you think?
Well, it could be, but it must not be. Especially for the convertible loan, there are some defined terms and conditions who could use by the investor and also by the startup company. And so it must not be complicated to create terms and conditions, especially for the convertible loan.
Okay.
Does this was the question?
I think so, yes. So we can't interact right now, but as far as I understand, I think you met the question exactly. Another question from a participant is regarding KPIs. Most of the time, KPIs are defined for the financial performance of the company. What are examples of other non-financial KPIs?
For example, the customer acquisition, not the cost, but the quote, so the customer acquisition quote, or for example, the revenue rate, which describes how often potential customers click on your online shop, for example, or also on your website, and at how many of these clicks you sold products. A pretty good revenue rate is, for example, 2 or 3%, up to 5%. That means that you sell or sold goods and services and products to 5 people of 100 clicked on your shop or on your website.
Okay. Another question is more or less on the pitch deck. So I think your presentation was already very close oriented at a potential pitch deck for an investor. But the question was here, what are the main or most important contents that I have to show in an informative pitch deck to an investor?
First of all, you have to show your company purpose, and this should include what is your mission, what is the company mission, and also describe the company and what do you want, what the company do, ideally in 1 to 2 sentences. The second step is to describe in detail the problem and also your solution. This includes your value proposition, your USP, maybe also your IP. And how do your customers value your offering, of course, which describes the value, the already mentioned value proposition. Define and assess also, for example, if you can, concrete benefits a customer gets from using your products and services. Describe also the market opportunity, but also the risks which are in the markets, which are also alongside the market opportunity. What is the market? What is the market creating potential also on the customer side, but also on the competitors and on your side? Give also a prediction of the size of the market, total addressable market, serviceable addressable market. We've already talked about this today. And figure out your competition. Who is the competition? Where are the competition? Where are you? Is the competition global? Is your market local? Is your market global, but the competition local, and so on? And summarize all these in a structured and clear business model. And figure out from that your commercialization and also the marketing strategy for the company, which includes, of course, some financial projections. What is your sales? What are your clients? What are the investment projections, for example? And we've already talked to this topic today. Most of the important topic is the team. Who are the key team members? What are, for example, relevant other players? Do you have an advisory board, for example? And convince also that the team has the determination, for example, also the forcefulness and also the expertise to achieve the commercial success of your company and to achieve also the growth strategy you've mentioned out in your business plan. Summarize all these in a short conclusion, ideally where you also place your actual and also your cap table, but also your funding journey. So you see, as you already mentioned, structured and detailed pitch deck, more or less 10 slides, 10 bullet points, should be also presentable at more or less 10 to 15 minutes and includes all the topics we've talked about today.
Okay, thank you, Uwe. Another question from a participant is about the investment process. So how long typically does the investment process last?
Typically from the first contact, for example, at an investor's day to the closing, to the signing, to the closing, it takes 6 to 9 months. Actually, of course, due to the Corona crisis, it could take also some months later more, but in general, the typical time frame is 6 to 9 months. But also it depends, of course, on the funding journey and also on the high of the amount you've asked for.
Okay. Another question is about the famous debt valley. So the phase for a startup after receiving first funds, but you're not yet in the market to generate sales. Mm-hmm. So what is your opinion? How can such a startup facing this debt valley? As an example, if a startup has to invest in marketing first to populate a social platform.
You have to ensure that your funding journey is high enough. I've mentioned already, double it, because the costs come in twice and the revenue not. So you have take care that you have enough investment to go through the death valley, so-called, but also take care to get the so-called right investors, maybe to creating an advisory board with expertise who have in marketing, markets, for example, global market entrance in USA, etc. You can help, which can help you not only by financial amount, but also with the so-called smart or also so-called sweat money to introduce you in different other markets, for example, to support you in marketing, to support you in sales, to support you in, for example, studies or something like that, to overcome the death valley.
Okay, very good, Uwe. Thank you for this one. One company is asking, what is the best way of presenting new opportunities towards investors without look like digressing? In this special case, for example, the company has an opportunity with antiviral coatings, but their main activity is actually antimicrobial coatings. So how can they present her new opportunity towards investors?
Maybe a suitable way is to do a new company, for example, who have also a new company purpose, who do not attach the purpose of the old, so-called old company. But also you have to convince that your team has the knowledge and also the capabilities for the new market, for the new approach, and you also convinced that you have the benefit and also the right route, so-called route to market, and also the support from your investors to get in these different market directions, at least.
Okay, thank you. Another question is, after we get the attention of an investor with a pitch, business plan presentation, what should be the discussion topics in further talks with the investor?
Of course, the matching potential of different investors, of different kind of investors, for example, business angels or VCs. So you should also talk about your risks you are faced and how your contacts and potential investors can support you due to these risks. You should also talk about also the vision of the investor, but also the vision of your company to get a relatively high matching quality and matching potential between you and your investor. And of course, you have come to the point by saying to the investor how you want to support it by the investor. Is it direct? Is it indirect? Is it, for example, due to an advisory board? Do you want a silent participation? So you can see and figure out which investor suits best for your company and also for your growth approach.
Okay, thank you very much. Just one note to the people that are still asking questions. We still have a lot of questions in our pipeline, and we're running out of time. We have only 12 minutes left. Therefore, I would like to ask to please give very, very short questions. Otherwise, unfortunately, we can't accept them anymore. Regardless, I have actually 3 interesting questions here received from participants regarding a very actual topic, the Corona crisis. Mm-hmm. So we also have concerns here regarding the crisis. How to continue investment preparations during the Corona crisis?
Yeah, pretty good question. Currently, it can be seen that most of the investors are holding back their capital and also their money for already existing portfolio companies to bring that safe due the Corona crisis. But nevertheless, we have also isolated transactions in that time, especially also for example, due to CureVac and BioNTech and cases and that in the bio and medtech area. But nevertheless, you should use the time right now to prepare your investment process well with all the topics we've talked about today, especially to get investment ready after the actual Corona crisis, and to scale up and also to accelerate the process after the crisis.
Okay, another question related to the coronavirus is, what are the important factors to focus on for an investment round during a situation like this? Like we have it now with Corona, where people can't see each other, where other topics come to the main focus. What is important there to focus on?
Well, our opinion is that we start after the Corona crisis in a so-called green technology century. So the investment should also make an impact on the society, but also on the earth, on the nature, and also on the health and well-being, wealth on the society. So we can see that globalization has also a so-called dark side. So it is also necessary to get back system-relevant companies and also system-relevant products to Europe or also to different countries. So this could be a pretty interesting investment case for after the crisis.
Okay, thank you. With the last questions related to Corona we received so far is, in general, what is the influence of the crisis on the investors' decisions criteria right now?
Yeah, well, I also already said that the most investors are holding back their capital for existing portfolio companies. So I think the time gap is at least 3 or 4 months, or maybe longer, when regional or traditional investments could be done again.
Okay. Thank you for that one. I have one question I have received regarding the InvestHorizon Accelerator program itself. So maybe I can answer this question directly to the participant. So the question was, for InvestHorizon Accelerator, can you please briefly mention the criteria for selection? How stringent are the criteria? So there are several criteria you have to fulfill. One is that your company is based in the European Union, the Horizon 2020 membership, or the Eureka, or to be a Eureka member. You have your product that you are developing should be a deep tech product. You have to receive funding of at least 200k euro in the past. One question we always receive is, how stringent is this criteria? So actually it is a criteria that should be fulfilled. However, each applicant is individually assessed by the InvestHorizon members, and we are relatively flexible to variations in previous fundings. So we assess this actually on a case-by-case basis. So if your seed fundraise is in a good process, we might accept this. Yeah, and at least you and the supporting investor have to commit to take part at all the sessions during the trust group program we offer to our participants. So that is one question I have received. Then another question I have here is related to potential investor candidates. You explained a little bit about the long list and the short list in your presentation, Uwe. The question I have received is, how can I select potential investor candidates for the short list?
Yeah, well, there are several different aspects. For example, the stage of your company, where we already talked about today, the investment budget, and also the expected returns on investment on the investor side. Are there any regional focuses for investments? Are there any technology and market focuses of the investors for potential investments? So in which field of branches of industries they invest in, and also in which branches, in which industries they can support with contact at least. Do you want either direct or indirect participation? What wants the investor? Some investors don't want direct participations. Some investors only look for convertible loans or mezzanine investments. What kind of support do you look? Is it either operational or also strategic support? Do you want an advisory board? Do you want the support in an advisory board? Do you want a daily support in an operational area, and so on? So you can define a lot of criteria, and so you can build up something like a filter which you can, which allows you to filter some potential investor candidates to get a detailed and also qualified shortlist of potential investors.
Great, thank you. Another question I have received from a participant is regarding customer-funded business versus the venture capital financement, which arrives sometimes often too early in the investment phase, whereas the startup has not developed enough its sales. What is your opinion on that, and what are your recommendations to develop our sales when we are a deep tech startup?
Okay. Yeah, pretty interesting question. So you are basically in a lower stage, so-called. So you are in a funding stage, startup stage. May you have to do a proof of concept. So with the triple F model, family, fools, and friends, and also by the topic from the last webinar from our colleague from, I think, Austria. There are several potential instruments to get also contacts, but also to get sales in the market, contact in the market, and also intermediates in the market. And so you can rise up your sales in the market, also in deep tech companies in some cases. But in general, for deep tech companies, it's more difficult, such for companies, for example, in wholesaling or something like that.
Okay. Another question again on investors itself and how to get in contact with investors which have a high matchmaking potential.
Yeah, it could be difficult to get in contact with potential high matching investors. So you have several matching platforms around the globe, but they are mainly in the most cases only VCs and in some cases also institutional investors listed. Business angels mostly act more in the background, so it will be helpful to cooperate with intermediates, for example, M&A boutiques or something like that, because they know or have a broad network and have in some cases also direct contact to different investors, different business angels. And also these business angels have a broad network in the background. So you should use intermediates like like M&A boutiques or something like that. And M&A boutiques are also intermediates to business angels, and business angels are also intermediates to other investors, other business angels. Because often they know each other personally, which increases at least also your matching potential and also the matching quality with potential investors at the end of the day.
Okay, thank you. As we have just 2 minutes left, but a couple of questions are still open. I will give it one last question for today. It's around valuation. Unfortunately, I can't repeat the whole question. It is very, very long. However, but in general, Uwe, how can companies determine the valuation of their business?
Excuse me, I didn't understand the question.
How can companies determine their valuation of their business?
Okay, yeah. There are different methods. For example, the discounted cash flow approach. The discounted cash flow method is mainly for early stage businesses to determine return on investment, but also to determine less an allowance for risk. Yeah, of course, it's difficult for early stage companies how successful they will be. So you also must make projections, you also must make assumptions, you also must make WACs, of course, and also build up scenarios. But on the other side, for established companies and established businesses, Series A, B, C, and so on, there are also another, let's say, common rule to thumb for based on a multiple on turnover or multiple on profit. For example, there are 2 times annual turnover or also 3 times profit to get a fundamental evaluation about your company and also about your idea and about the values in your company, such as team, such as IP, and so on. So you can also measure your assets in the company, especially with the DCF method.
Okay, thank you very much, Uwe. With that, I will now close the Q&A session. Thanks to all the participants for the lots of questions, and especially to Uwe for for and for his answers on all the questions. Again, thank you very much for participating in this innovative way of improving your investor readiness level. We hope this is the beginning of a lot of success story with your companies. Last but not least, please be aware on one thing: we are continuously improving our services in the InvestHorizon Accelerator, and your feedback in this respect is crucial and highly appreciated. So we would like to ask you to please fill in the satisfaction surveys that we will send to you after the webinar. With that said, thanks again to everyone. Looking forward to see your success and speak to you soon. Thank you very much.
Thanks a lot. Take care.